Hello, hope you're having a nice weekend and a wonderful Sunday. Today we're gonna talk a bit about NetEase. This is another Chinese company, and we typically talk about the ADR, which is the same company that is being traded in the US, really. And so during this, recent time when all sorts of Chinese companies have gone down in value, and then all of a sudden, because the Chinese government has actually eased some of the concerns for China and the Chinese companies, now we're getting these companies going up much higher again and kind of reaching their normalcy. And in this mid this period, we want to be getting these companies potentially if they are good value and can actually serve for a nice investment that is going to be yielding us some nice income in the next few years. And so I have talked a lot about Alibaba, Tencent, JD as well, Baidu, but I haven't talked about NetEase, and I thought this would be a nice opportunity to make a video about it. And I may also want to be making a video about Didi, which I think is an interesting company to look at as well. But first things first, for this one, we're going to be taking a look at the financials as we usually do, and we're going to have a discounted cash flow model to see how much the company is worth. So stay tuned. And if you are new here, please leave a like, that really helps, and consider subscribing because we're making tons of videos. And if you're around, you will eventually get access to our exclusive tool that is being designed for analyzing these companies the way we do in this video. So, what's going on here? The outstanding shares of the company, let's take a look at those. They're at about the same as they used to be in 2013, although they have actually gone up and down a little bit. The thing is, in the last 5 years, they're still sitting at pretty much the same amount, so that's nice to see. There was a little bit of an increase, then a little bit of a buyback. Okay, I'm fine with that. I mean, that's not a big deal. Again, look at these levels. We're basically at the same level after 5 years. So that's good. Even more than 5, actually. Okay, so that's pretty good. So that's not a concern. So what's next with the company? The PE ratio that we're looking at right now is 23. And the next 12 months is going to be 18.6. Now, if you know me, PE ratio is something that I look at. It is important, but it's much more important to be examining the cash flow of the company, because net income can be skewed by all sorts of different ways, and free cash flow is much more difficult to skew, although it's possible. But this is why we're using a discounted free cash flow model that actually takes into account the net income as well. And I'm going to be talking about it pretty much near the end of the video. But let's first take a look at some of the other important metrics. And we start off with the dividend yield, because the company actually does pay some dividends, and we want to be examining the payout ratio. And you see that the payout ratio is sitting at 21%, which is pretty great. I mean, anything below like 40 to 50% is nice, because the company can afford it. And the payout ratio is basically the portion of net income that the company has to pay in order to fulfill their dividend obligations. And this way we can know whether the dividend is safe or not. And in this case, it's fine. So next thing that we're going to be taking a look at is going to be the income statement of the company. And we are looking at a company that is almost $60 billion in terms of its market cap. Let's take it back to about 5 years here, which makes more sense. And as you will see, the company's revenue growth is about the same, is between 15 for the most part, and 24 is like the odd one out here. So it's mostly between 15 and 20. This is something that I like to see, generally speaking, the fact that the company has been growing at similar rates, because it can help me evaluate what the discounted free cash flow model is going to be using here. It's much more easy to have this kind of consistent results. So I like to see that. And it's also not bad growth at all, especially when it has happened for the last 5 years. So that's good to see. And the net income of the company is sitting at about $2.6 billion here. And it is a little bit less than what it used to be in 2019. So there was a little bit of a stalling net income here. But okay, this can happen with companies. Not every company is going to be making money forever and going up forever. I mean, so they're still making money, but their growth is not going to be the same every year, of course. And they can have some bad quarters, for instance, or even years in some cases. So the total assets of the company have been increasing as well, and I do like to see nice balance sheets. From 11 billion here to 24 billion, that's good. And the total liability is at 8.5, which is a big difference actually. That's another good thing. And the total equity of the company doubling from 2017. So that's pretty great. Okay, the cash flow statement here. The cash from operations also increasing from 1.8 to 3.9 in the last year. That's great. The cash from investing here. The company is investing in a little bit of stock in the stock market and some capital expenditures, normal stuff. So they did buy quite a few market securities here, especially in 2020. Okay, that was a good year to buy. This is when I bought a lot myself, actually. So, cash from financing here, and you will see that the last year, really, the company has been repurchasing common stock, and also 2020 as well. So a lot of repurchasing happening in the company right now. Good to see that. So very, very good. And a little bit of long-term, short-term debt actually. And yeah, nothing curious here, nothing weird. The free cash flow of the company from 1.5 billion to 3.7 almost. That's pretty good free cash flow here. And especially when you compare it to the market cap, that's very fair, 3.6 billion. All right. So let's take a look at the multiples, sitting at about where I want them to be. I'd like them to be a little bit less if possible, but near 3 is, is pretty good to me. I mean, I like to see that. So the profitability of the company is sitting at 18% in return on equity, which is what I mostly look at. Pretty good. That's actually pretty good as well. The solvency is sitting at 22% total debt to equity, so not a lot of debt for the company. You kind of saw that, and you got a glimpse of that when you looked at the total liabilities of the company here. So the liabilities of the company were sitting at 8.5 billion, and if you take a look at the cash flow of the company, they are making 3.6 billion, so they can use 3 years of free cash flow to pay all their liabilities, and that's pretty great, because the company has no trouble with debt, is pretty much what that means. So that's great to see, but let's take a look at how much we should be willing to pay for the company, because that's important as well. Now, we do know that we have a great company here. It's making good money, it's increasing its bottom line, great balance sheet, great income. All of these things matter a lot. But again, we want to be examining how much we are willing to pay for the company. And you will see here that the averages is what we pointed out earlier. They are pretty much, for the most part, the same thing, with a little bit of stalling for some years, but that's normal. So I'm gonna go with, I want to be relatively conservative here. I'm gonna go with 10, 12, and 14 over here, which is not the most conservative thing actually, because the 3-year average is 10.5. So we could go a little bit lower. Actually, now that I think about it, let's go a little bit lower, 9, 10, and 12, just because we have this figure here. The net income margin is similar as well, which also helps, because as you can see here, most years are relatively similar. So we should be expecting to get something like, let's say, 16, 17, and 18% in terms of net income margin. And again, we're being conservative here. We can always be trying all sorts of different metrics and see where we want to take it. And the free cash flow margin, again, pretty similar here. We did have a few years of 65% and 87%, but for the most part, I'd say we should be sitting near 90, 100, and 100 and 105, let's say. And the annual return that I want to be getting is about 13%, because I can get about 10 just by buying an ETF, S&P 500 ETF. So if I am to invest in a single company, I want to be getting more. So I will hit calculate, and let's see what we're getting here. So we are seeing that with all our estimates here, we are actually below what we want it to be. And this is $90 right now, the company stock price, and our highest estimates give us a max price to pay today of $85. So we're a little bit off. We'd like to get a little bit of a discount. So I suppose before the company went higher, so if we take a look at the overview here, we'll see that in the last, let's say, 5 days over here, it used to be 73. So this was a fantastic opportunity here, or even over here, 70. And this was a fantastic opportunity because, as you can see again in our model, our medium was about 70. So we could have purchased the company at our medium estimates here, medium projections over here, and would be good to go. But as it is right now, I would like to wait for a little bit of a better discount if I am to buy this company, or I could just, allocate my capital in other companies that are, having better max price to pay here. So that would be, for instance, Alibaba that I have talked about. It's much cheaper than this. Now again, it's a great company, but I'd like to get it at a better price, because this is the core thing about investing. You want to be buying great companies, but at a great price as well, because that's how you make money. So thank you for watching this one, and I hope you enjoyed and it helped you a little bit with your decision on NetEase. And thank you for sticking around, and again, please like the video, that helps a lot. And subscribe if you are not a subscriber already, and I'd love to see you around. And in the meantime, take a look at this video that I made a couple of days ago, and I'm discussing about cryptocurrency and whether it's a wise investment or not. And I'll see you very soon in the next video. Bye bye.